Following the sharp increase in new COVID cases in Greater Sydney over the last week or so, we've had to revise our forecast for the timing of the end of the lockdown in Sydney. We did have the 20th of August, but we've now extended that to the 30th of September. We've also expect that the construction sector will only operate at 60% capacity over that period. Now what that means is that we now expect that the growth rate of the New South Wales economy in the September quarter will fall to minus 7.8%. And that'll drag down the national growth rate to minus 2.2%. However, we do expect to see a very strong recovery in both New South Wales and Sydney in particular in the December quarter. October will be a month of a staggered reopening of the economy, but over the quarter we expect that the economy in New South Wales will rebound by 5.8%, and nationally we'll get a 3% growth rate for that quarter. One of the key factors in the strength of the recovery will be the sharp increase in vaccinations by that December quarter. As the demand for vaccines continues to rise, as vaccine hesitancy and vaccine complacency fall substantially in the face of what we're seeing now in New South Wales. On the other hand, governments will be pushing very hard to boost supply, and we expect that the supply numbers will be even stronger than we're currently expecting. So that'll lay the foundations for a strong recovery in the fourth quarter, with that recovery spilling over into the first quarter of next year as well. So in the first half of next year, we're expecting growth at around 3%, that's 6% annualised. So we've lifted our 2022 growth rate from 3.2% to 4.2%. Unfortunately, our 2021 growth rate, because of this shock in the September quarter, has been reduced from 4.8% before we saw the lockdowns in New South Wales to 3.2%. So what will that mean for the labour market? Well, the labour market is very strong coming into the New South Wales lockdowns, both in New South Wales and nationally. So that will act to moderate the impact on jobs. We've also seen the JobSaver initiative from the government, where companies are being encouraged to not to sack workers and are being paid 40%, up to 40% of their payrolls in regard to that. Nevertheless, I think that over the September quarter we'll lose about 200,000 jobs, but regain 185,000 jobs in the December quarter. The unemployment rate, which is currently at 4.9%, is likely to lift to 5.7% by September, but to come right back to 4.8% by the end of the year. And next year, we think that the unemployment rate can get down further to around 4% by the end of 2022. Under those circumstances, we believe that the Reserve Bank is still on track to raise interest rates in the first quarter of 2023. 4% by the end of 2022 is where we see full employment, and we expect that inflation will be back within the 2 to 3% band from the second half of 2022. Now, of course, the Reserve Bank Board meets on August the 3rd, and I think what will happen is that at the August board meeting, there'll be revised of new forecasts by the Reserve Bank staff. And while I'm not expecting the Reserve Bank staff to have exactly the same forecasts as we've just discussed, I certainly believe they'll be advising that the September quarter is expected to now see a contraction in New South Wales and in the Australian economy. Bear in mind that we're expecting that growth in 2021 will come down from 4.8 to 3.2%. Now, under those circumstances, remember that in the minutes that the Reserve Bank released for its July meeting, they talked about needing to be flexible with their bond purchase policy. And bond purchases could either go up or go down depending upon economic conditions. Now, at the moment, their commitment is to cut back their purchases from $5 billion a week to $4 billion a week at the beginning of September. My view is that such has been the change in circumstances, with a contraction in the Australian economy now likely for the September quarter, that the board should review that decision to cut purchases back and indeed to immediately lift their purchases from $5 billion to $6 billion for the remainder of August and hold that $6 billion pace at that level until the November board meeting, when we expect New South Wales will be out of lockdown and the signs of the recovery will be quite clear. So I would expect to see the Reserve Bank respond to what we're seeing at the moment and use their new flexible policy to support the government in its efforts to deal with the impact on the New South Wales economy and overall the Australian economy of the current lockdown. We've also released some forecasts for house prices. And you may be surprised that we think that Sydney house prices can still increase by around 6% to the end of this year. That'll have Sydney house prices up by 22% in 2021. Nationally, we're expecting that house prices will lift by 18%, and that's up from 15%, which was our forecast back in February. Next year, we're expecting some momentum to continue into the first half of the year, and that'll be a time when I think the Reserve Bank will realise that with the recovery well underway in Australia and the vaccination levels at very high levels and that momentum remaining in the housing market, that they have to look at containing housing price increases and housing credit growth with direct macroprudential controls. And the signal will be when housing credit growth reaches around 7%. So in the second half of 2022, we're expecting house prices to flatten out. And then when the Reserve Bank starts to raise rates in the first quarter of 2023, we're expecting house prices to come down by about 5%. But our view is that the extent of that tightening cycle will see a peak in the cash rate of 1.25%. So we're not looking to see an over-tightening by the Reserve Bank in this cycle, and therefore the -5% we're expecting in 2023 is not what I would call a significant shock to the housing market. So certainly we live in interesting times. A contraction in the September quarter, a strong recovery in the December quarter, 200,000 jobs lost in the September quarter, but 185,000 regained. The Reserve Bank responding with an increase in their purchases of bonds, house prices rising, but reaching a peak around the middle of next year, flattening out and then falling in 2023. Thank you very much.